As you've probably heard in the news, pretty much everybody is talking about the possibility of a recession on the horizon. And in this video, I want to talk about some things we can do to recession-proof our portfolios if a recession does hit in the next year. And specifically, I'm going to show you my investing plans for 2020. And as you guys know, I'm not a financial advisor, so this is not personalized financial advice for your specific situation. This is just education and what I'm doing in my portfolio. And a couple of weeks ago, I wrote this blog post on Medium talking about how I'm investing going into 2020 and some of the lessons that I've learned from investing in Bitcoin since 2013. And a lot of questions popped up around this article, and most of them had to do with a recession. Like, what do we do if a recession hits, or is a recession coming? And look, I am by no means an expert in global macroeconomics, but I have been doing a lot of research, and I've been through 2 prior recessions, and I've learned a few things, and I feel pretty confident going into this next recession if one does hit over the next year or two. So we can start by just recapping the first part of this article to kind of set the stage and show you guys the mental model that I use when I approach investing. So one thing I like to do is I approach investing like a chess player, right? I like to ask a lot of questions and think deeply about these things. I ask questions like, what do I see that the mass majority of people might be ignoring? Or what are the future possible outcomes and what's most likely to occur? You know, I feel like on social media and in the news, you know, people get celebrated for trying to predict what's going to happen. And as I've talked about in prior videos, I think that's just a foolish way to approach the markets, right? We're dealing in terms of possibilities and probabilities, not absolute outcomes. And I also think about like what black swan events or unforeseen things could throw off any thesis or hypothesis that I might have developed, right? Or what do I believe that most people might disagree with me about? So as I've been thinking through a lot of these questions, one thing that came to mind was thinking about why so many people get hurt or lose money during recessions. And a common scenario that I see is people that have like a 401k or an IRA, or maybe they own some stocks or bonds, and maybe they don't even really fully understand what they own. Maybe they own some real estate or gold or crypto. But the problem happens is when a recession does hit, it's usually too late, right? Meaning prices have already fallen by 30, 40, 50%. And by the time your average investor realizes like, hey, we are in a deep recession, what ends up happening is they likely sell the bottom. So a good example of this is the Great Recession from 2008. And what we're looking at here is the S&P 500, and this is early 2007, and this was the bottom here in early 2009. And you'll see here on the S&P 500 that prices fell by over 50%. And the problem was, yes, there were some signs of a possible recession through 2007, but your average mom and pop investor really didn't wake up and realize that we were in a deep recession until here in late 2008, right? And that's why a lot of people that aren't really paying attention end up late to the game, and they end up actually selling the bottom. So how do you protect yourself if a recession does hit? Well, I see really 2 main options that you have. The first option is you can try to guess or anticipate when a recession is going to hit and sell whatever assets you have, your stocks, your bonds, real estate, whatever, and then just kind of hope that prices fall where you can buy back lower. Now, the danger with that is exactly what sounds rational, is you're guessing where the high is. And as we know, like bull markets can last for much longer than people expect. And what seems rational, you know, the markets just don't always follow. So I think that's kind of a bad plan. But the other option that you have is you can actually take some of your capital and put it into assets that typically do well during recessions. So let's take a look at some of the asset classes and strategies that can do well during recessions. And if you think about it, most people own long-only stock bond portfolios, right? Where you own shares of Apple or Google, or you own a broad market ETF, or you own a little piece of most of the stocks in the US or your home country, right? And the problem is when prices fall, those assets lose value, right? Like if you have $1 million stock account, if you are, all things being equal, if it falls by 50%, you lost $500,000, right? A way to hedge against that is through what's called a managed futures account, which basically can profit when prices go down, right? So there's really two options you have when it comes to trading futures. And the benefit there is you can short the general market or individual assets. And you have two options. You can either trade futures yourself or you can hire a firm to do it for you. And I've personally noticed the futures markets over the past 15 years become incredibly competitive and overrun by PhDs and mathematicians and just really, really smart people with billions of dollars in their funds. So instead of fighting that, recently I've actually moved about 15% of my assets into managed futures funds. And I'll link up this website, rcmalternatives.com. I don't have any connection with these guys, but they have a lot of good education and information about managed futures accounts. And on their homepage here, you can actually see, like, this is just overall like a ton of funds, kind of like the broad performance of many different companies. But you can see during the financial crisis in 2008, when stocks were down over 50%, on average, managed futures did about 18%. Now, that's taking all the funds into consideration. So the really good ones actually did over 50% gains when everybody else was losing 50%. You can see during 9/11, very similar picture. During the dot-com bust, when stocks were down 45%, managed futures were up over 30%, right? So how do you invest in a managed futures fund? Well, they actually have some really good infographics here, but I'll link up some of this stuff in the description, but you can see they have this one that shows the top 100 managed futures programs, and they break them up into categories. So if we kind of zoom in here, you can see some of these funds do trend following, which, again, they can make money on the long side or the short side. Some of them focus heavily on currencies. Some of them are volatility driven, just a few of them. Some of them are multi-strategy or agricultural or, short-term. So these are like your day trading quants. But if you look at kind of the $140 billion in assets under management in these types of funds, you can see the green, the trend following, is the largest. And then kind of second is multi-strategy. And one of the smallest is day trading, because day trading the stock market has become so incredibly competitive and difficult that I actually tweeted about this a couple of weeks ago, saying, trading firms have actually been stepping up the firing of manual traders and hiring of coders and quants. This continues to push out short-term retail traders. And then I went on to say, in my opinion, the only way that individual traders can compete is to increase the hold times of their trades, right? Or do what I'm doing, which is outsource this to really smart people, right? So I'll just tell you a little bit about kind of my philosophy and the funds that I've invested in. I look for a fund that has at least 2 or 3 decades of public performance that is positive and either matches the S&P, but especially outperforms during recessions. They need to have at least a few $100 million in assets under management. And I like fully quant-based or completely systematized, because, again, the markets are so competitive today that if you're just in there trying to emotionally chase price, you're probably going to underperform. And then I'll link up this infographic as well. It shows how different asset classes react during crisis periods, right? So they look at everything from real estate, bonds, equities, stocks, and they break down equities into international stocks, private equity, right? So like startups and private companies, large cap, like your Apples and Googles, small cap. And then they also look at alternatives. So your alternatives are things like managed futures, commodities, gold, hedge funds, long, short. I believe that in the near future, they're probably going to need to add crypto and Bitcoin to this. But if you just come down and you look at during all of these different crisis periods, managed futures are typically the asset class that do the best during these time periods because, again, they can profit and they can use leverage when the markets are panicking, right? So instead of being that investor that by the time it's too late and we realize that we're deep into a recession and asset prices have already fallen, why not be positioned in a way where instead of losing capital, you can hedge your long-only portfolios with some kind of managed futures allocation that makes money when the prices crash. Now, one of the biggest downsides to these managed futures programs is a lot of them are limited to accredited investors, and they have pretty high minimums, 6 or 7 figures for the best funds. So if you're dealing with a smaller capital base, it might make sense for you to learn how to trade futures or short yourself. But again, be very, very careful because using leverage and actively trading on your own, you're going up against these guys, right? Like this 140 billion is not really a lot of money compared to the overall stock market. And futures are a zero-sum game. So you are literally competing against these people if you're trying to trade on your own. Now, the other assets that can do well during recessions, and the ones that you guys are probably most interested in, are things like Bitcoin, right? So Bitcoin has shown to be pretty uncorrelated from the overall stock market. And this is, in my opinion, the best form of hard money today, right? I'm also a fan, and I have been actively accumulating precious metals like gold and silver since about 2014, right? So I've been really patient throughout the past several years, kind of buying in the 12 to 1300 range. And then you can see on these recession fears, gold has recently broken out above that really key 1400 level. And again, this is against the US fiat currency. If we look at gold compared to the euro, Canadian dollar, and the pound, it has exceeded all-time highs. So, the US dollar has been relatively strong recently, which is why, for the most part, it's still below the all-time highs, but we have broken out of that really key resistance level. So again, Bitcoin and gold and other just hard money assets and commodities typically do better in times of a recession. And going back to the article that I published talking about some of the lessons I've learned about Bitcoin, I'll give you guys just a little bit of history for those of you that don't know and haven't been watching my videos since the beginning. I look at the Bitcoin and crypto markets in a few phases, right? As I've been in this space for so long now, I've seen how this stuff has developed over time. And if you haven't been with me since 2013, let me kind of give you a little perspective. So 2013 to 2015 is what I consider kind of the early accumulation phase, right? Like obviously you had an opportunity to get in from like 2010, but really exchanges and public awareness started to happen during this 2-year time period. And this is where I went all in on crypto. I was actively trading the financial markets. I realized they were getting more competitive. And during this time period, I just turned my focus because I strongly believed that Bitcoin was the future. And then what happened in phase 2, this is what I call mainstream awareness in the ICO bubble. This was 2016 to 2017, where after Bitcoin had its first bubble, where it went from 100 to 900 and then crashed, we had another accumulation period. And then 2016 is when things started to heat up. And I noticed like my YouTube subscribers were growing really quickly, and the keywords for Bitcoin and cryptocurrency were starting to get more attention. And it's funny to say this, but like this is what led to the bubble in 2017. And even though I made a life-changing amount of money that year, that was my least favorite time to date in crypto because a couple of weird things started happening. I had a lot of impersonators creating fake social media accounts and even copying my website. And after being one of the first guys in the world to do videos about Bitcoin, it seemed like there was like a new crypto guru popping up every 24 hours. And I've actually considered quitting YouTube altogether and just kind of retiring. But after talking to my community and really thinking about all the people that have been on this journey with me for so long and seeing how many other people have made life-changing amounts of money, like I've decided that it's worth it. Like I really do enjoy doing videos, and it helps me learn. And I learn from the feedback that you guys give me. And so I've just really decided that I'm going to keep doing what I'm doing. But anyway, fast forwarding. So then phase 3, we had the popped bubble and the ICO purge, right? So after Bitcoin kind of topped out around 17K to 19K, depending on what exchanges you're looking at, we had a really big reaction from people that chased the high, and then we had a big crash. And I still think that there are a lot of ICO projects that still need to fail. But I feel really good about where the crypto space is today, because really we're in the plateau of productivity and we're leading into more mainstream adoption. As you guys have probably seen, I mean, you know, it's crazy. Back in 2015, like I was literally on a tour and I self-published a book trying to convince Wall Street that like Bitcoin was real. Now every day on CNBC, you know, the Wall Street Journal, like it's everywhere. People are aware that it's here. And now we're kind of in that plateau of productivity where there's real development happening and there's real adoption around the world. And as we can see, you know, after the bubble popped, Bitcoin has already had a really nice bounce off of the last accumulation period. So when people ask me like, Chris, you know, what's the best way to get into Bitcoin, or how are you investing in Bitcoin? This is kind of my strategy. I'll just scroll down here. I don't look at myself as an active trader anymore. I look at myself as a retired trader that comes out of retirement when there's something that's just too good to pass up. Now, with that said, I am active in the markets, and I think of my investing, and the older I get, you know, when I was in my early 20s, like I was okay with sitting in front of my computer for 12 hours a day and trying to catch every move I could. But now that I'm over 30, I'm like, you know, my hold times get longer, right? So I have a preference of a minimum of a 2 to 3 month hold with a bias towards a 2 to 3 year hold. Just because I've noticed like the longer my hold times become, the more profitable those trades are. And that's why my motto is trade less, profit more, because the number one reason that traders lose money is over trading, right? So with that said, I think of things in like 3 capital buckets. Like capital bucket number 1 is your cold storage holdings, right? This is just like if you bought gold, you know, as an inflation hedge or as a hedge against the shit hitting the fan. Crypto is the same way. Like you can use it as a store of wealth and accumulate it post bubbles. Like when a bubble pops and Bitcoin's price is extremely volatile, instead of being fearful when everybody else is like running for the exit, that's when you can start to accumulate, right? And we're starting to see the market cycles actually kind of speed up a little bit because now we have institutional money coming in. The capital bucket number 2, this is more of like a multi-year position trade, right? Where you're trading the larger market cycles and you can respond to mass euphoria and mass fear and profit based off of that. So basically it's very, very simple. There's 2 ways to do that. When people are fearful and they're selling, you accumulate and you buy looking for the next market cycle. And when everybody is euphoric, you can sell. So there's really 2 goals. It's like when prices are cheap, you want to accumulate to increase your Bitcoin value. When prices are expensive, you want to maybe trade or sell some of those positions to increase your fiat value. That way you have even more capital to reinvest when prices have a big sell-off again, right? And there's a skill set to that. But the 3rd capital bucket is short-term trades. And again, I'm not really focused on this anymore. And I think that this is where the mass majority of people lose money, is by trying to actively day trade, meaning get in and out on every little move. But every now and then we do get like really nice bounce plays or just fast trades where you can make 20 or 30%, but those are few and far between. So again, some of the things that I am doing as a precaution or a hedge against a recession is putting capital into some managed futures funds that have a history of doing well during recessions. And number 2, continuing to accumulate non-correlated assets or assets that do well when a recession hits, like Bitcoin, gold, even land, right? But one thing that I think we can be defensive about, and asset classes that I think are more risky, is obviously the stock market, right? Like right now, even if you own like a broad market ETF, like obviously we've been over 10 years now in a bull cycle. There is risk that we could have a sell-off on those. But for me, I'm not going to sell any of my equity positions right now. I'm just going to hedge those with futures, right? Because again, there is a possibility of a recession, but it doesn't have to happen. And it doesn't have to happen like it happened in 2008. It could look really different, right? But I am pulling back on investing in some other asset classes that I think are even more risky, which is startup capital, right? Like probably about 7-8 years ago, I became really active in the angel investing space. And I just see a lot of risk with that. Like in the event of a recession, I think private equity and early stage companies are going to get hit really hard. And we're going to see a lot of failures there. So I've kind of pulled back on that. Also like new IPOs, like if you guys have seen the recent news about WeWork and companies that are just, they're going public at these really stupid valuations. I am not excited about that. I am not investing in any IPOs coming up in the next year or two. And residential real estate, both like multifamily and single family. I think that those asset classes right now are pretty risky because rates have been so low for so long. And you know, if you go to any major city that people actually want to live in, the cap rates on multifamily stuff is like 4%, right? So if you want to own like anything from a small apartment complex up into something really large, your returns are going to be shit. Also with residential real estate, I don't know. I just feel like there's a lot of over leverage in that space, and I'm starting to see some of the same mortgage behavior that I saw back when I was in the mortgage industry during the last real estate boom and bust. And so I'm also staying away from that. So just a few more points, you know. Again, the bigger my capital base becomes and the older I get, the longer my hold times are. You might be in a different time in your life where you're like, look, I'm trying to grow a little bit of money into a large amount of money, which is fine. But again, I would just caution anybody that's thinking really aggressive right now that maybe right now is a time to play a little bit of defense in the public markets. Again, I'm not a financial advisor, so go talk to whoever you use and make sure you're allocating your capital wisely. Also, learn about futures, learn about shorting, and don't try to guess when a recession is going to hit. You know, markets can stay irrational much longer than we can stay solvent. And I'll wrap up this video with a question. Like, what do you guys see that maybe a lot of people would disagree with you about? What do you see that most people maybe aren't paying attention to? Or how are you positioning yourself against the possibility of a recession? So, guys, I hope this video was helpful. Thank you so much for watching my videos over the years, and I hope this adds value to your life. Feel free to leave a comment and share this with anybody that you think would get value from it. Look forward to seeing you guys next time.